Two neighbors, same street. One leases a new SUV every 3 years. Spotless, always the newest trim. The other drives a 9-year-old Camry with a dent nobody's fixed. If you had to bet which one could walk away from their job tomorrow and be fine, who would you pick? Most people would bet on the SUV. Most people would be wrong, not always, but often enough that it should bother you. Because the car in the driveway tells you what someone can afford to display. It tells you almost nothing about what they can afford to lose. That gap is the whole subject of this video. Income is the number your employer decides. Wealth is the number that survives after your life has had its way with it, after the rent, the repairs, the 4 a.m. emergencies nobody plans for. And the decisions that build that second number rarely get photographed. They're quiet, repetitive, a little boring even, but they leave marks if you know where to look. Call them fingerprints. Here's how big the confusion actually is. PIMT's Intelligence has been tracking this for years, and their most recent data from mid-2026 puts roughly 2 in 3 American consumers in the paycheck-to-paycheck category. But that number hides an important split. Within that group, roughly 40 to 45% say they pay their bills comfortably. They just don't have much left over each month. Only about 20 to 25% say they're genuinely struggling. And this isn't just a lower income story. More than 60% of consumers earning between $100,000 and $150,000 a year still report living paycheck to paycheck. A bigger salary buys a more comfortable version of the same tightness. It doesn't automatically buy room to breathe. The Federal Reserve's household survey confirms this from a different angle. In their most recent report, about 37% of adults said they couldn't cover a sudden $400 expense using cash on hand, and not a $400 problem. Income alone doesn't sort people cleanly into who's in that group and who isn't. So if salary doesn't predict security, what does? A handful of everyday behaviors, each one revealing something different. The first is how someone absorbs a shock. A $2,000 repair bill hits every household eventually. The difference is what it does once it lands. For someone without a cushion, it can mean high interest debt, a missed bill, or pulling money out of investments at the worst possible time, turning a bad week into a bad year. For someone with a reserve built for exactly this, it's an inconvenience they forget about by Friday. There's no single correct size for that reserve. Depends on job stability, dependence, insurance coverage, and how predictable your income is. A freelancer with no safety net needs a bigger buffer than someone in a stable salaried role. What matters is that the fund exists before the emergency does, and that it sits somewhere safe, liquid, and earning something. Traditional savings accounts have paid historically low interest for years, often a small fraction of a percent, while competitive FDIC-insured high-yield accounts have regularly paid several times more. Rates move constantly, so don't treat any specific number as permanent. The principle doesn't move. Park emergency money somewhere it can actually work while staying instantly accessible. The second fingerprint is sitting in the driveway. A new vehicle looks like proof of money. It's often proof of a long-term obligation instead. As of early 2026, Experian's data puts the average new car payment at $770 a month, with close to 1 in 5 new car loans now running past $1,000, frequently stretched across 6 or 7 years just to make the payment feel survivable. The real lesson here isn't never finance a car. It's that every large recurring payment competes with something else that money could be doing. Run $770 a month a different way. Invested consistently for 30 years at a hypothetical 8% average annual return. A common long-run planning assumption and absolutely not a guarantee. And it grows to somewhere around $1.15 million. That doesn't mean the car is wrong. It means the choice is bigger than it feels standing in the dealership. And almost nobody runs the comparison before signing. The third fingerprint shows up on the credit card statement. Used well, a credit card is a genuinely useful tool, like fraud protection, purchase records, rewards, a credit history that opens doors later. The problem isn't the card, it's the balance. Average credit card interest rates have been sitting around 21% recently, though your actual rate depends on your card and credit profile. and roughly 45% of cardholders carried a balance for at least 1 month over the past year, according to Federal Reserve data. Carry $5,000 at that rate, and you're paying over $1,000 a year for the privilege of having spent money you didn't have. Money that builds nothing and buys nothing. The behavior that separates people who've built wealth isn't card avoidance. In Ramsey Solutions' national study of millionaires, the largest survey of American millionaires ever conducted, with more than 10,000 respondents, nearly 3/4 said they've never carried a credit card balance in their lives. Same tool. Completely different relationship with it. If this is landing, stick with me. The habits coming up next do more of the actual work than anything so far, and they're rarely explained clearly anywhere. I'm John. If you like money explained without the noise, this channel is for you. The fourth fingerprint is what happens to money the moment it arrives. Most people save whatever's left after spending. People who build wealth tend to reverse that order. A percentage moves automatically into a 401k, an IRA, or a brokerage account before it ever becomes available to spend. This isn't a claim that wealthy people have superhuman discipline. It's the opposite point, and it's more useful. Automation removes the decision from the exact moment temptation is highest. You can't talk yourself out of a transfer that already happened. The gap this creates has less to do with salary than most people assume. Take two hypothetical earners, one making $60,000 who automatically invests 20%, $12,000 a year, and one making $150,000 who only manages to invest $4,500 a year. Run both at a hypothetical 7% average annual return for 30 years, and the lower earner ends up with roughly $1.13 million versus about $425,000 for the higher earner. Same market, opposite outcome. The percentage mattered more than the paycheck. If your employer offers a 401k match, it's worth understanding the fine print. Match formulas and vesting schedules vary by company, and unvested employer contributions can be forfeited if you leave too soon. But within those rules, an employer match is still one of the closest things to free money in personal finance, because it adds to your balance before the market has done anything at all. And there's more room than most people use. The IRS raised the 2026 employee 401k contribution limit to $24,500. The fifth fingerprint is what the money is actually used to buy. The simplest way to think about it, things that can generate income or grow in value over time work for you. Things that only cost money to own and lose value the moment you buy them work against you. A diversified, low-cost investment fund or a paid-off rental property tends to fall into the first category. A financed boat or a closet of things losing value the day they're bought falls into the second. Homeownership illustrates this with a caveat worth stating clearly. Federal Reserve data from 2022 shows the median homeowner had a net worth around $396,500, compared to roughly $10,400 for renters, a striking gap. But that gap isn't proof that buying a house makes you wealthy. It reflects age, income, timing, inherited advantages, and who was even able to qualify to buy in the first place. The honest takeaway isn't buy real estate. It's that owning productive assets over enough time tends to compound in a way that renting the same value never can. The sixth fingerprint is how the investing actually gets done. There's a persistent myth that wealthy people got there by picking the right stock at the right moment. The data doesn't support it. In that same Ramsey study, about 3/4 of millionaires pointed to regular, consistent investing over a long time horizon as the main driver of their wealth. Not single stock bets, not market timing. Many long-term investors favor diversified, low-cost funds precisely because diversification spreads out risk, even though it never eliminates it. Downturns are part of the deal, not a sign something's broken. Run $500 a month at a hypothetical 8% average annual return for 30 years, and it grows to roughly $745,000, with only $180,000 of that ever coming out of your own pocket. The rest is time doing work no amount of stock picking skill reliably replaces. Again, 8% is an assumption for illustration, not a promise. Some years will be down years. The math only holds if you stay in the market through them instead of selling at the bottom. And the last fingerprint is the one that ties all the others together. Someone with real financial security can usually tell you their net worth within a rough range without thinking hard about it. Ask their salary instead, and you'll often get a shrug. Because in their mental model, income was never the scoreboard. Net worth is simply what you own minus what you owe, and it's the one number that actually tells you whether the other decisions are working. This is why someone earning $300,000 can be less financially secure than someone earning $100,000. Income measures what flows in. Net worth measures what's left standing. For scale, the Federal Reserve's most recent survey puts median U.S. household net worth at around $193,000. Reaching the top 10% nationally takes roughly $1.9 million. Worth separating from a different number you'll sometimes see quoted, which is what households already inside that top 10% hold at their own median, closer to $3.8 million. One is the door, the other is how far people go once they're through it. Most people chasing either number are still watching a completely different one, their salary. Some of this comes down to something deeper than math. Spending isn't only about acquiring things, like it's often about communicating something to the people around us. A newer car, a bigger house, a nicer table at dinner, all of it can double as a signal whether we mean it to or not. That instinct isn't a character flaw, it's just expensive when it runs unchecked, and almost nobody examines it directly, so go back to the two neighbors. The real question was never who looks richer, it's who has more options. Who can absorb a bad month, walk away from a job that's not working, or take an unpaid week off without a knot in their stomach? Real financial security isn't always visible. It's what's left after everything else has taken its cut, and it's what eventually buys back your time. Which of these habits are you already running on autopilot, and in which one are you going to change this month? Tell me in the comments. And if this shifted how you think about looking rich versus actually being secure, the next video breaks down the money lessons most of us were never taught in school